Well, coming up on this episode of the Smart Mortgage Show, we're talking about the three pillars of mortgage approval: credit, income, and assets. We're going to break it all down, explain what that all means, and how it applies to you when you're looking for your new home. Hello and welcome in to the Smart Mortgage Show. I'm Ben George with Bill Linton, Regional President at Cross Country Mortgage. Bill, what's going on?
Hey, Ben. How you doing?
Doing well. How are things in Chadds Ford, Pennsylvania?
Great. They're great. Things are warming up, and we're just getting ready for spring and summer.
Absolutely, and we got a good show for you coming up. If you're listening to us, we appreciate that. Join us on YouTube as well. There's a link in the description to bring you to our channel. We're doing videos now, adding some graphics, giving you some things to see to kind of highlight some of the information that we're sharing here, talking about mortgage lending and covering a wide variety of topics about lending and just questions people have going through the home buying or refinancing process as well. And today, Bill, we're going to focus in on the three pillars of mortgage approval. So, as I mentioned before, in the T's here, what are those three pillars?
Yeah, so the three things that we really key in on, they're the most important items, are credit, income, and assets. Those are the three most important. Now, collateral, right, which is the home, is also really important, but we're talking about the actual borrower, right, because the collateral they don't necessarily control. So the three things that we have control over: credit, income, and assets.
Perfect. So I want to kind of work through each of these. So someone that's maybe going through this process for the first time, or it's been a while since they've gone through it and just want a refresher and kind of get a better idea of how to maybe best position themselves in each one of these three pillars, we'll kind of break down each one for you. So let's start with credit. I know people know what credit means, Bill, but what actually goes into your credit?
Yeah, so credit is really important in lending, and there used to be programs that almost ignored credit, and even in the programs today that are considered like alternate lending solutions still focus on credit. And the main things that we're looking for in credit is, number one, most important thing across all loans is your credit score. And your credit score, two main drivers are that you pay everything on time, and that means you're never 30 days late on any car loan, mortgage, student loan, credit card, car lease, things of that nature. Doesn't take into consideration your utilities. There is a way now you can put your utilities on your credit report if you want to help feed into your score. We see that with a lot of younger, first-time home buyers or people that are trying to bump their scores up. But it's payment history, and then it's also utilization ratio. So if you have a credit card that's got a $1,000 limit and you owe $950 for a 12-month period, that, even though you pay it on time, your scores are going to suffer from that because you're extended and you have no flexibility, you have nowhere to go.
You even compared that to if you had the same $990 on a $10,000 credit limit. That's just a fraction of the amount, right? So it's the same amount, but it's looked at differently by the credit scores.
Great way to put that for people that aren't thinking about this every day, right? So in one instance, the first instance, your utilization ratio is at about 100% almost, right? 950%. In the other example, you're at about 10%. You've got 90% available credit on that credit card. So the important thing there is, we always say you want to keep your utilization ratio below 25%. So if the limit's 10,000, don't ever go over 2,500 to have the best credit score.
Okay, that's important to know. And also, knowing these things, you're able to work with a borrower ahead of time before their mortgage, right, to maybe make some positive impact on their credit score.
Yeah, I had a conversation yesterday with a customer that's done quite a few loans with us and wants to put his wife on the next one. We didn't have her on there previously because of her scores, but we want to add her so that we can use her income. So we talked about ways that we could get her credit scores to be more in line with his so that putting her on the loan doesn't hurt in any way, because we're always going to focus on the low credit, the middle credit score of the lower credit score borrower.
Okay.
So now if we get them both up to be the same in the top tier, then there's no negative effect.
All right, very good. So credit, that first pillar, again, as we go through this and you have questions about your application process, what the lending might look like for you, you can always get in touch with Cross Country Mortgage at 484-352-4151. So pillar 2 is income, Bill. So what are you looking at here for this pillar?
Yeah, so income is how much money do you make, and then putting that against the mortgage payment and all of your other debts to come up with a debt-to-income ratio. So what is the ability of this person to make the payment? So if your income is $5,000 a month and the mortgage payment's $5,000 a month, you have no money to do anything but pay the mortgage. You can't even buy food, right? So that would be a really bad situation. Whereas if your income's $5,000 a month and your mortgage payments, for example's sake, and we don't see this a lot anymore, but if your mortgage payment's $1,000 a month, now you've got $4,000 discretionary income to put food on the table and fuel in the car and car insurance and everything else that you need to do, utilities, etc. So income is proving the ability to pay back the money, and credit is historically what has their likelihood been to make payments, right? So we're putting this picture together. So we see they've always made their payments, and now this big new payment that's probably going to be the biggest payment they've ever had to make in their lives if they're a first-time home buyer or even a move-up buyer. What is their ability to make the payment based on the amount of income they bring in?
All right, so you're able to kind of paint a pretty good picture through those two, credit and income. Then you have assets as well, the third pillar here. How does that factor in, Bill? What are you looking for in terms of what someone has for assets?
Yeah, so assets primarily come into play to show, do we have enough money for the down money and the closing costs? And is it their money? Is it a gift? Did they borrow the money, and is there some big payment out there that we're not aware of that now needs to be factored into their debt ratio? So that would be a problem. So if we can't source the funds, they're ineligible. So verifiable, eligible funds for down money and closing costs. Now, beyond that, sometimes the lender is going to want to see that you have reserves, money in the bank after settlement. And then what they're looking for there is if your down money and closing costs were $100,000 and now you're taking on a $4,000 a month mortgage payment, did you spend your last penny to get into the house? What if the heater breaks or the hot water heater breaks or there's something that happens where you need a rainy day fund? Do you have any money in order to get you through that rough patch? Reserves are important. The other thing we do with assets is leverage them as income. So the lender recognizes that, hey, if your income isn't quite where it needs, but you got $1 million in the bank, that increases the likelihood that you're going to have the ability to repay that loan.
All right, very good. So credit, income, and assets. Is any one of these three pillars more important, or do you kind of weigh everything equally?
You know, back in the subprime days, you could be deficient in 2 of the 3 and still get a loan. Now, you really need to be able to demonstrate that you've got a at least satisfactory level in all 3. So I think they're all really important for sure.
If you want to go through and see what your credit, income, and assets actually mean for you in terms of getting a mortgage loan, what that lending might look like and what your rate might be, all these things, right? You want to get in touch with Cross Country Mortgage, you can always do that. We'd love to hear from you. Always welcome you to call Bill and his team at 484-352-4151, or again, log on smartmortgageshow.com. If you have any questions about the process, he'd be happy to help you answer them. But also drop a comment below on YouTube, and we'll try to sort through those. And if there's something we can bring to the show, maybe do a future episode on that. We'd love to help you there, but we'll always willing to kind of help you and focus on the education part of this process. I know it's so important for so many people, Bill. So thanks for breaking this down. I think it's interesting to kind of see how this all plays out and how you're looking at it from your perspective to help the home buyer better understand what their options are.
My pleasure. Happy to help. Like Ben said, we're always here to help. Please reach out. Thank you.
Well, thanks for listening or watching on YouTube, The Smart Mortgage Show. For Bill Litton, I am Ben George. Have a good week. This program is for informational purposes only. Please consult a qualified professional before taking any action. Bill Litton is a loan advisor and regional president with Cross Country Mortgage, NMLS number 147060.